Hello everyone, it is Summary Saturday where I give you a brief overview of yesterday's Finance Friday topic. Yesterday we discussed the difference between growth stocks and dividend stocks and which you should buy. So I've been seeing so much information recently coming out about how dividend stocks are amazing and everyone should buy them. And I think it's because dividend stocks are considered safer investments than growth stocks. And since there's so much uncertainty in the economy and in the marketplace, investors are searching for anything that will allow them to reduce their risk, but still receive a decent return. And I think dividend stocks are a way that they're trying to do that. So today we're going to discuss what the difference is between dividend stocks and growth stocks, why dividend stocks are safer than growth stocks, and why I think you should skip the dividend stocks even though they're safer and invest in growth stocks instead. So first of all, what even is a dividend stock? And a dividend stock just means you're investing in a company that pays a dividend to its investors. And a dividend is a percentage of a company's profits that it pays out at regular intervals as a form of return for investors. So companies that typically do this are well established, they have a large market share, and they have minimal investment opportunities for growth. So they pay out a portion of their profits to investors in the form of dividends as opposed to reinvesting them all into growing their business. Growth companies, on the other hand, are usually less well established. They are trying to seize market share, and they reinvest all of their profits into trying to continue to grow their company at a rapid rate. So two companies for comparison that represent these well are Microsoft, which is a dividend company, well established. They have a ton of market share. And then Tesla is a great example of a growth company who is really trying to seize market share and is continually innovating and doing new things to propel itself forward. So what makes a dividend stock safer than a growth stock? And one reason why they're considered safer is because they're less volatile. And so volatility just means basically that the stock price is going to fluctuate and go up and down less than a growth stock. And while that is great to reduce your risk, it also means that the return that you're going to receive on dividend stocks is typically going to be lower. So you do expect their stock price to increase over time somewhat, but much less than a growth stocks would. So you typically will see less reward from dividend stocks. Another reason why they're considered safer is that you get to realize some of your returns from your dividend stocks before you actually sell the stock in the future. So in a growth company, and the way most people think about stocks is that you buy the stock and then you hope that the price goes up, and then when you sell later, you make money on the difference. And that's how growth stocks work. But with dividend stocks, it's actually the compilation of the dividends you receive throughout the time you hold the investment, as well as any increase in price in any increase that the stock price has over the time that you hold the investment, and when you sell it you also get that. So it's safer because you get to actually get some of the cash for your return throughout the time you hold the investment. And so therefore, if the stock price actually declined in the future and you had to sell, the dividends that you had received would help to offset any losses from the stock price declining. Whereas with growth stock, you don't have that luxury. If the stock price declines and you lose all your money, you have no dividends to help compensate for that. Another way that they're safer is because they're less affected by market declines, which is why they're so popular, I think, right now. But again, less volatility means less reward. And one thing that there is a caveat to this is that dividends are not guaranteed. So once a company starts paying a dividend, it doesn't have to do that into eternity. And so sometimes when markets decline, companies that pay dividends will be experiencing operational issues and they will have to cut their dividends completely. And if a company does that, it's usually a terrible sign in the market and their stock price will plummet, and you could actually see a lot of losses from the decline of their stock price in that scenario. So it can be a little bit worse depending on how that company fares in a market decline, but overall they tend to do a little bit better. So some of the risks associated with dividend stocks are that sometimes companies will use their dividend payments to mask other operational problems that they're having. So if investors are just continuing to receive dividend payouts or the dividend is increasing, they may just think that everything is going fine with the company, but that is not always the case. And not most necessarily, but a lot of investors will just choose a dividend company to invest in that has the highest dividend yield. And dividend yield is the percentage of a company's profits that it pays out. So you would think that if a company has a super high dividend yield, that's great for you because then you get more dividends. But if a company is not doing healthy operationally, you do not want them to be paying out all of their profits in dividends. And it's really important to also look at a company's overall earnings and make sure those are steadily increasing. And to make sure that they have enough free cash flow. Because essentially what a company is doing when it pays a dividend is saying, I don't see any other investment opportunity for this profit that would provide a larger return to my investors than paying them this dividend. So if a company is declining or not doing well, there are definitely other growth opportunities for that company so that it can get back on track. And if they're paying out all of their profits to investors to try to cover that up, instead of investing in the business, that is not a good sign and that is not a good investment. So if you are going to invest in dividend stocks, it's really important to make sure that overall the health of the company is good and they have enough free cash flow. They aren't taking on any debt to pay their dividends, and then have a high dividend yield. Then that's great. But a high dividend yield alone is not a good reason to invest in the company. Another risk factor for dividend stocks is interest rate risk. So interest rate risk means that basically other investments like bonds are going to become more attractive as interest rates rise because bonds are less risky than dividend stocks. So once interest rates rise and investors can receive a comparable return by investing in bonds as they can to investing in dividend stocks, they may sell their dividend stocks because with bonds they'll have less risk and receive the same return. So since dividend stocks provide a lower return typically than growth stocks, if interest rates rise, they'll hit the dividend stock threshold first. So growth stocks also have this risk, but it's going to happen later. So interest rates are super low right now, so this isn't a huge consideration, but just something to know going forward. So now that you know all of that, why should you invest in growth stocks instead of dividend stocks? And if you are young, that's because you are trying to grow your money as much as you can. And if you invest in dividend stocks, you need a substantial amount of money to really reap the benefits that dividend payments give you. And if you have $100,000 invested in dividend stocks and the average dividend yield or like the average dividend payout is 2.2%. So if you receive 2.2% on your $100,000, you're going to make $2,200 a year from your dividend payouts, which is not even close to enough money to live on. And the real benefit of dividend stocks is the passive income that they provide. And this is something that a lot of people look for like in retirement. So if you're young, you can handle the risk of growth stocks, and growth stocks will provide you a substantially larger sum to work with in investments as you age, so you can really reap those benefits. So if you're young, like around my age, a millennial, definitely invest mostly in growth stocks, and then you can really amp up the amount of investments that you have. Once you get closer to retirement, you can start transitioning those risky growth stocks into dividend stocks, and you'll have much more money to be able to reap the benefits of those dividend payments when you're older. So as long as you maintain a well-diversified portfolio, you should have bonds and other less risky investments to help reduce the risk of your overall portfolio. So if it really made you nervous about all of the stuff we talked about growth stocks, don't worry. As long as you maintain a well-diversified portfolio, you should be able to reap the benefits of the returns on growth stocks and still manage some risk levels. So I hope this helped you understand more about growth stocks versus dividend stocks. On Instagram, you guys asked for more investing tips, so this is for you. And thanks so much for tuning in, and I will see you next week.